Good afternoon. This afternoon's sessions are going to have presentations from each of the 5 business unit leaders. We'll kick this off with our new division, Investment, Savings and Retirement. So I'll ask Euan and Munro to come to the stage.
Thanks, Chris. I'm actually quite impressed. We were almost running a book on how many would leave at the interval, and most of you have turned up, so thank you for doing so. So good afternoon. I'm delighted to be announcing the creation of a new Aviva business segment called Investments, Savings and Retirement, which I'm excited to lead. This business has been formed from 2 parts of the wider Aviva group: the global asset management business, Aviva Investors, and the UK savings and retirement business that resides within UK Life. Our workplace and advisor business already serve over 3.5 million customers, and combining that reach with Aviva Investors' investment strengths, we believe gives us an enviable position. Together, they can propel Aviva to a leadership position in UK savings and retirement, and that's exactly what we're going to do. Our goal is to lead this market by size, by proposition quality, and by client experience. By 2022, we're targeting net flow onto our platforms in UK savings and retirement of 10 billion, and net flow of 10 billion from third parties into Aviva Investors. So 10 and 10, hopefully suitably memorable. I'm confident of meeting these objectives, and when we do, the new structure will become a really relevant capital-light growth engine for Aviva. Aviva's built a modern savings platform business in the UK, which benefits from wide distribution reach. Our workplace savings business holds pole position. Our advisor platform's in the top 10 from really nowhere 5 years ago. And we have outsized positive net flows, so our ranking is improving rapidly. In our savings and retirement proposition to UK customers, we have an ability that pure play asset managers cannot match. We have access to the UK insurance balance sheet. This means UK savings and retirement can offer standout propositions, including elements of equity release, annuitisation and fund smoothing. In Aviva Investors, we now have well-resourced and well-regarded asset management capabilities. We're delivering strong performance across most asset classes, including growth areas such as real assets and ESG. I believe it to be the match of any other fund manager when it comes to fund solutions. So we have all of the necessary investment and distribution capability and the technology platform necessary to deliver a fantastic customer experience. And this is what we believe will propel us to become the UK's leading savings and retirement solution provider, as well as being a successful global asset manager. We've actually been building to this point for about 5 years. The UK savings and retirement business has invested in modern, scalable technology and used our digital expertise to improve engagement. And crucially, we've also added an advisory capability of our own. And I'm personally proud of how we've transformed Aviva Investors. The new leadership team has built out risk and compliance, real assets, multi-assets, distribution, and most recently, equity management. We've improved long-term investment performance, and this year we'll be back on track growing third-party assets under management. We've already capitalised on the symbiotic relationship between UK Life and Aviva Investors. Angela's business needs real assets, and we have built an origination engine to provide them. It's been so successful, it's now one of our leading sources of third-party assets. However, I want to be clear, we have punched below our weight in delivering our own products on our own platforms. And under the new structure, I'm determined that this is going to change. Put simply, we're going to get paid not just for the platform, but for the solutions. And this will deliver a better experience for our customers and better margins for Aviva. The central insight behind the UK savings and retirement proposition is that we are uniquely positioned to help customers from accumulation through to retirement. And this is a journey that's shown on my slide here. In the UK, the top 1% own almost 25% of the financial assets. And the most wealthy are already very well served by advisors, and we in turn serve those advisors. And they're served by platforms that are rich in investment content. But the needs of the 99%, if you like, are not well met. Many aren't advised, and they're expected to navigate this complex journey alone. We think that's bad for society and individuals, and it's a space that Aviva will fill. So my vision is that we'll be the wealth manager to those of ordinary means, the wealth manager to the 99%. And these households need different things. We know them. We understand them. Our brand resonates with them. For example, few of the most wealthy will need to tap into the equity in their homes in order to navigate retirement. But many of the 99% will have to do that, and we can help with that. The 99% will need access to rich and diversified fund solutions as well that won't let them down when quantitative easing and low interest rates end, and we can help with that. And with so much responsibility for retirement planning lying with the individual, they need the tools to make the right decisions. And guess what? We can help with that too. So from the moment our customers auto-enroll in their first pension to the moment they need to start thinking about their inheritance and how much they're going to leave behind, my commitment is that Aviva will be with them every step of that journey. So how are we going to build a high-quality, sizable and profitable savings and investment business? Well, first we're going to do it, and this is fairly obvious, but we're going to do it by growing the assets under administration on the savings platform business, something we've been doing really well for a while. Second, we're going to do it by continuing to grow assets under management in the asset management business. And third, as a unified business, we're going to maximize the overlap between the two and create a financial home for the mass market in the UK. I'm now going to explore in more detail these three different routes to growth. Firstly, in the UK savings and retirement. This business is led by Lindsay Ricks, an outstanding executive who's passionate about delivering the best customer experience, and she is sitting there on the front row beside Patrick. And I'm sure under her leadership, we will continue to grow. But first, let's be clear about the size of the opportunity that we have today. In Workplace, we serve, as I've said, 3.5 million customers. We're trusted by 26,000 pension schemes. 5,000 of them have over 250 employees. We hold the number one position in the UK. This is a distribution powerhouse with huge potential to sell higher value propositions. Turning to advisors, we are top two, but we are number two in net flow. So we're improving rapidly. And this has been achieved without any great savings and investment emphasis in our marketing messaging. And this is going to change. We actually also offer a unique mix of componentry to help us win. For example, we're number one in individual annuities and number two in equity release. And we've got exceptional TNPS scores, 53.7, 71.6 respectively for those two areas. We already have 200,000 equity release customers, and this is a growing market, 30% over the last 5 years. And it supports this key need to release equity from their homes, and in many cases, an essential part of the retirement journey. Similarly, while the individual annuity market has been flat in recent years, we believe that the ability to provide a guaranteed level of income will continue to form an important part of retirement planning. Now we have all of the pieces in one place. You'll see us push the message that Aviva is a true investment, savings and retirement brand. But our customers won't just hear about how good we are, they'll experience it. For example, we've just recently launched a product to assist customers with pension tracing consolidation. One of the problems is pension funds are scattered around and people can't get a sensible picture. We can help them do that. You can expect to hear more about hybrid propositions forged between Aviva Investors and UK Life, such as the new Smooth Managed Fund. With greater brand awareness and better proposition, we can expand our market share at better margins in this growing market. Turning to Aviva Investors, what we're announcing today will provide a push to Aviva Investors' ambitions as a global asset management business. From an essentially captive business 5 years ago, we've made significant progress. The business now has fresh leadership, a world-class risk and control environment, strong distribution, deep asset class capabilities, and ESG is fully integrated into our investment processes. As many of you know, ESG has gone from a nice-to-have to a deal-breaker. And I'm proud when it comes to sustainability, we are at the head of the pack. Just last week, ShareAction recognised us as a top 3 manager for our long-term record in voting on environmental issues. And crucially, our performance is back on track, with 70% of our funds beating benchmark over 5 years. We're attracting the recognition of the gatekeepers to our industry. We now have over 50 positive consultant ratings compared to pretty much 0 5 years ago. As many of you will know, these ratings lead to asset flow, and we're seeing this turn sharply in the second half. The real asset business, a result of our collaboration with UK Life, has been critical in helping us diversify away from the AIMS range of funds. We now have a very diverse book of third-party business and an even more diverse pipeline. Real assets and US credit being our standout growth engines at the moment. Of course, Aviva Investors is founded on running assets for other Aviva Group companies. This will remain a critically important part of my business. This year, for example, we've had exciting success designing and distributing ESG funds with Patrick's team in Aviva France. However, in recent years, we have experienced asset runoff from the mature part of UK Life. What I'm announcing today will reverse this flow as we win new assets from the new savings front book. Here I've set out the key priorities of activity and my priorities for the business. In the corporate market, we will continue to grow both our institutional third-party asset management business and the workplace pension business. However, there will be deeper integration between the two because we'll be positioning our own fund solutions with UK corporates. We'll be outspoken advocates of high-quality, active asset management and ESG, and we'll be much more proposition-led and less administration-led in our messaging. We've recently, for example, launched the Stewardship Lifestyle Strategy, an ESG solution to our workplace platform, as one of our default options. We know that this is an area where most employers are keen to show their workforce that they're taking environmental issues more seriously. Where we're confident around customer benefits, we will promote our own solutions with more conviction. As far as customer acquisition is concerned, we'll have the group brand marketing support positioning Aviva as the savings, investment and retirement provider with sustainability at the heart of our values. The workplace pension business, as well as being attractive in its own right, gives us access to individual savers by the millions. This is an important route to introduce these retail customers to the broader Aviva offer. Not having to sign them up one by one is a great advantage for us against challenger asset managers for whom customer acquisition is proving to be a very long and very expensive slog. So how should we be measured? Our plans for this business are ambitious, 10 and 10. We expect flows on the platform and third-party flows at Aviva Investors to be 10 billion or more by 2022. It's worth noting that we have substantially completed our capability build at Aviva Investors, which from now on has considerable operational leverage as we grow assets. This year, we incurred a full year of costs associated with the last of our capability building projects. We built out our equity team. And this weighed on us in a year when our perimeter changed. We sold our real estate business last year. We saw a drop in origination fees on account of lesser bulk annuity writing, and of course, lower performance fees and some outflows on account of previously weak investment performance. However, third-party asset growth has turned around in the second half of this year on the back of our rapid performance improvement. In fact, the annualised rate of net third-party asset growth in the second half could be around 5 billion, which would make that chart look considerably better. And it makes me bullish about achieving the target by 2022. In the UK savings and retirement business, the investments we are making to improve our customer experience and the propositions we offer, and we offer them, it means that we are confident about hitting this objective too. In the spring, we'll set out profit targets for this new business segment, but you should expect to see margin improvement as we grow the assets. So to complete the vision, investment, savings and retirement will operate as a capital light and efficient growth business. We'll promote our high quality solutions to our 26,000 pension plans and 3.5 million customers and their advisors. We believe the external environment is conducive. We believe Aviva has the capabilities to make this work, and crucially, we already have momentum. As we implement our plans, Aviva will become the leading provider of mass market savings and retirement solutions in the UK and the owner of a strong international asset management brand serving third parties and global Aviva insurance businesses. I think it's an exciting future. I hope you agree. I'm going to pass on to Angela now, who's going to secure the dividend.
Thanks, Euan. And hello, everyone. I'm Angela Darlington, the CEO of our UK Life business. I've worked for Aviva for 18 years, many of those in the UK Life business. And more recently, I was the Group CRO before moving back to UK Life in April this year. UK Life is a fantastic business, which I'm incredibly proud to be leading. Importantly, it has a central role to play in Aviva's success. My clear objective for this business is to deliver dependable growth in long-term cash flows. Achieving these means having clear targets for our people and a clear customer purpose. We are experts at what we do, but we're absolutely at our best when we combine that expertise with empathy. And I think that's what sets us apart. It's one thing saying it. I want to share an example of what it means for our customers. This is what a customer who had a severe cancer diagnosis and swift treatment as a result of having a health policy said about us. I was told that although my kind of cancer is not curable, at least I was now in remission. The consultants are pleased with my progress and tell me that my positive attitude has helped my recovery so far. I tell them that having Aviva to back me up has been and is continuing to be a great boost to my morale. Of course, there's the cost via my monthly payment to you. On the face of it, it's a lot. But the benefit of having a policy with Aviva is proving to be a lifesaver, quite literally. One other thing, each time I go to the hospital and confirm that I still have my policy with Aviva, the receptionist invariably tells me that I'm lucky that my claim is dealt with so calmly and efficiently by you. So I sing your praises and will continue to do so as long as you and I are in this beneficial partnership. Thank you, Aviva, from the bottom of my heart. That is us at our best. That's why I do what I do. It's why our people do what they do. And that's why our customers have been given us great Net Promoter scores and why we've been recognised with so many awards. So what are my key messages today? We have leading scale across the UK Life with an enviable customer base of over 7 million, good brand recognition, strong core product franchises, and an excellent distribution footprint. Importantly, I'm also convinced that we have the skills and capabilities to continue to win in these markets. And whilst we undoubtedly already have some strong positions in some mature parts of the market, we also have excellent growth engines in annuities and equity release. And we haven't optimized them yet, so there is good room for value creation through careful capital allocation, in addition to minimizing complexity in our heritage book. Our target is clear, to maintain a Solvency II return on capital of 9.5%. As Jason said earlier, the BU target return figures are unlevered and therefore lower than the group targets. We will also provide the vast majority of the UK cash remittances to group of 4.25 to 4.75 billion over 2019 to 2022, in addition to the 500 million special dividend in 2019. This is a business which has the capacity to deliver dependable growth in long-term cash flows. So what exactly is UK Life? UK Life is the traditional life insurance business of Aviva. We have top 3 franchises in individual protection, group protection and health, a disciplined and growing bulk purchase annuity business, manufacturing for our individual annuity and equity release businesses, and a substantial heritage business with over 2 million customers. You can see from these charts that we are a strong contributor to the group. In the past 2 years, we've contributed heavily to OCG and group centre cash, with 1.8 billion of OCG and 2.2 billion in cash remittances to centre. And in 2018, we contributed very nearly half of the group's operating profit. But that's all in the past. And Maurice said this morning, today is about what we will deliver. So I want to share with you a future projection before going on to talk about the fantastic Aviva franchises which support our growth ambitions. This slide shows our expected trajectory in OCG from 2018 to 2028. The projection is taking a prudent view of our 10-year outlook. New business for every year is assumed to be the same as our 2019 outlook and is UK Life only, excluding any capital generation from the investments, savings and retirement business. We are, of course, aiming to beat 2019's new business going forward. This is simply a useful illustration. The graph does show the level of OCG coming down markedly this year from the historically high levels of the last few years, where one-offs and significant releases in areas such as longevity were dominant. But this is not a surprise. We all knew it was coming, and it's in our plans. We're now entering a more normal period for the business. We have a lower base, but we also have a clear, solid plan for growth. I'll take you through the component parts of this projection step by step. Let's start with our existing business. As you can see, there's quite a stock of value here, totaling 5 billion over the next 10 years. The OCG runs off at 6% per annum over this period, but you can see that there remains value in the book even 10 years from now. This projection is based on our current assumptions, but we have plans to improve these, particularly our retention levels. We've also built in planned expense reductions as they are necessary to ensure a slow, steady runoff of this book managed efficiently. So how are we filling the gap as this business declines? With new business. In this graph, we're assuming 100 million per annum capital usage for new business. This simply assumes that we'll write similar business to that we're on target to write in 2019. I should say that we are not constrained to this £100 million of capital usage. It's been a product of our careful risk selection and capital efficiency in 2019. In future, if we can source additional business which meets our required financial returns, we would be quite content to invest more capital, provided it doesn't lead to an unbalanced portfolio. Over time, that new business starts to generate sufficient OCG to more than compensate for the runoff of the back book. Fundamentally, this capital generation is a function of the discipline we are applying and will continue to apply when we're allocating our capital. In particular, for the annuity business, which is where most of the capital is being invested, we are achieving a payback of 4 to 6 years and unlevered returns in the low teens. And finally, we've added an allowance for one-offs and management actions, which Jason referred to earlier. Over this extensive time frame, it's hard for me to say exactly what they will be, but we're already working some into our business. Also, it's worth noting that if you exclude the Friends Part 7 and longevity impacts, we brought through 200 million of management actions in 2017 and 2018. So as you can see, we have a clear path for delivering OCG growth. And it's my belief that this sample projection is cautious. There is exciting opportunity in this business, and I'm confident we have even better performance than this in the bag to come. And we'll do this all while generating cost savings. We've embedded our share of the 300 million cost saving target into our projections, which brings the unit cost down from its 2018 level of 43 basis points to a target of 40 basis points. These expense savings have to come from a variety of areas. A decent part comes from reducing the amount of change spend, which we're already well underway with our planned change spend for 2020 already down by 20 million compared to 2019. Longer term, savings will be achieved from a combination of the closure of long-standing projects and the benefits from efficiency improvements generated by the investments we've made over the last few years. Moving on to our balance sheet, Jason has spoken earlier about the sensitivities of our balance sheet to market risks. You can see from the annuity cash flow matching profile that we have a well-matched portfolio, and so do not expect interest rate movements to be a material concern for the UK life business. We share this information about our portfolio regularly, but you can see that our credit portfolio remains well diversified. 88% of our corporate bond portfolio is investment grade, 99% if you include our internally rated assets. And we've maintained our discipline on our mortgage and equity release books. For example, our commercial mortgage portfolio, the average LTVs are 56%, and interest service cover is 2.75 times. And that interest service cover is twice what it was as we entered the financial crisis in 2008. In addition to maintaining asset quality, we've put up provisions for the risk of property market falls in case of Brexit, amounting to 400 million. This is equivalent to an immediate fall in property prices of 12 to 14%. So overall, we're comfortable with where our investment portfolio sits, but we're not complacent, and just as you would expect, we actively keep an eye on any risks emerging in the credit market. I thought it would also be good to provide some more colour on another key area, longevity. Like many of our peers, the UK life results have benefited materially in recent years from longevity. In the last 2 years, we've seen around 700 million releases each year. The figure is likely to be smaller this year, but will nonetheless be a significant contribution to the 300 to 400 million management actions which Jason mentioned earlier. However, more significant this year is the noticeable change in the trend in longevity. We saw far fewer deaths over the last winter than we have for many a winter, which you can see from the uptick in the blue line on the charts on the right. Of course, our business is impacted by more than 1 year, as we bring actual longevity experience into our basis over several years. If you look at the chart again, our reserving sits between the solid line and the dotted line. So we will see a significant release this year, but based on this year's experience, we are signalling an expectation of lower releases to come from 2020. Coming back to our businesses, my confidence in delivering growth comes from our great product franchises. Firstly, our individual annuity and equity release businesses. We are already operating in this space from a position of strength. Euan talked about how we expect both of these products to be important for our customers in their retirement and how we will further strengthen our market position. I will just say that as a manufacturer of these products, we will focus on maintaining high quality credit and longevity management, and increasingly allocating capital and our structuring expertise very actively across these lines of business and bulk purchase annuities. So let me move on to BPA. We've built our franchise in BPA in a disciplined fashion, and we've been doing this very successfully. We are a scale player in this market already, having executed over 500 transactions since entering the market in 2006. And we continue to show financial discipline in the transactions that we complete. To be clear, we do not want our book to be dominated by BPA business. So we've been growing while trading within capital, credit, and longevity limits across the book. And our objective for the next few years is to carry on in a similar vein. As you'll have seen, we completed a 1.7 billion deal with the Aviva staff pension scheme last month. This is likely to be the first of a series of transactions with a total liability to be transferred of around 15 billion. This will form the bedrock of our BPA volumes over the next few years. But we also plan to maintain a healthy flow of open market deals. Our BPA team operate with a clear capital budget and IRR and payback thresholds. Within these limits, we believe that we can build our BPA business year on year, with risk and reward being carefully managed through a variety of funding and reinsurance programs, and utilising our excellent asset origination capability, where we have a track record of over 20 years in both commercial mortgages and equity release. And I have absolutely no doubt that we have the team in place to go from strength to strength in the BPA market. Moving on to our protection and health businesses, these are important and profitable Aviva businesses with great franchises. We are number 2 in individual protection, 3rd in health, and number 2 in group protection, although we're number 1 writer of new group protection business if you want to take score on that metric. Let me tell you more about these businesses. Individual protection is a highly competitive market, but we have some clear strengths. A track record of product innovation, the widest distribution footprint in the market, and strong IFA relationships. Great customer TNPS scores of plus 53, and impressive data and analytics capability. For example, we've used Aviva's quantum data analytics faculty to develop machine learning tools to use in our underwriting processes. These are helping us to speed up customer outcomes and manage both costs and reinsurance spend. But we know that to keep winning in protection, we must continue to focus on detailed trading discipline and continually developing our product and proposition set. Earlier this year, we had seen our market share fall away a little amid intense competition, but we responded well, looking in detail at our pricing and service and using agile systems development to create new propositions. As a result, we've started to recover our market share, and we're seeing good results in H2. Our health business is a very attractive business with a great reputation and a strong TNPS score at plus 45. We're incredibly proud having won Health Insurance Provider of the Year for the 10th year on the trot in 2019, an amazing achievement. However, this is a sector with significant competition from the top 2 players, so we have to be clever in how we run this business. For example, we have a partnership with Vitality, which enables us to use our combined scale in negotiating agreements with hospital groups. Increasingly, our focus is on bringing the group protection and health businesses together for our corporate clients to help them improve the well-being of their employees. Simply put, better healthcare leads to better productivity. And I'm really happy with how that's going. Add into the mix Euan's market-leading workplace pensions business, and you have a compelling, holistic proposition to help companies support their employees' financial, physical, and mental well-being. And last but not least, our heritage business. This is a large back book with over 2 million customers and 93 billion assets under management. It provides a strong underpin to our capital and cash generation, although the OCG is running off at 15% per annum. My main aim for this business is to build trust and advocacy in order to improve retention, either within current products or within our new savings and retirement business. Again, we've been using our quantum data analytics to focus on having the right interactions with our customers at the right time. To date, we've seen a double-digit reduction in lapse rates following increased customer engagement. So let me sum up. We know where our strengths lie, we know where we want to grow, and importantly, we know how we are going to get there. In the nearer term, we have clear targets, which I'm happy to be held accountable for, because I'm confident we will deliver an unlevered Solvency II return on capital of 9.5%, a special dividend in 2019 of 500 million, and the vast majority of the UK cash remittances of 4.25 to 4.75 billion. To get there will require a clear plan and financial discipline in execution. We have both. Ultimately, our growth is all about delivering our expertise with empathy. Thanks for your attention, and I will now hand over to Colm to talk about GI.
Thank you, Angela. I won't take it personally. So, good afternoon, everybody. Just to introduce myself, my name is Colm Holmes. the CEO of Aviva's general insurance business. Some of you may remember me from prior roles as CEO of our Canadian business, and prior to that as MD of our UK general insurance business and CFO of our general insurance business at Aviva. It's a pleasure to be here today, my first time at our Capital Markets Day speaking, to talk to you about the ambition for Aviva's global GI business, our strategy, our key goals, and how we're actually going to deliver them. Aviva GI is a 9 billion portfolio that generated a core of 96% at the half year in 19. This has grown by 25% since we last spoke to you, which was at our Capital Markets Day in 2016. Recognized for our market-leading capability in digitization, innovation, service and distribution, Aviva possesses all the attributes and capabilities necessary to continue and improve on this growth and performance in the future. Aviva has invested heavily over the past 5 years on digital technology, product and proposition development, and the distribution advantage of the composite. These are some of the foundations upon which we are going to deliver sustainable, profitable growth in the coming years. But we also know we have work to do. We need to deal with our complexity and cost base. We need to leverage our strengths, and we need to be more focused if we are to realize the enormous potential of this business. I want to show you today the unrivaled strengths we have, but also where we need to be better. This is a self-help story that will deliver expense reductions, higher retention, growth, improved profitability, and a simpler business that can deliver that growth year on year without generating greater P&L volatility. So today we're announcing new targets for GI. These are to grow premium by 20% to 10.8 billion by 2022, deliver this at a reduced core of between 93 and 95%, whilst delivering a 2% reduction in our expenses. So who are we today? Aviva participates at scale in 2 global markets, the UK and Canada, but we also have an attractive European business across France, Ireland, Italy and Poland. These markets help us to diversify and balance our portfolio so that today the UK represents less than half of our global GI premium. In Europe, where we choose to play, we are material. In France, we have the fourth largest tied agents network, are the second biggest player in the direct market, and are number 4 in the agricultural sector. In Ireland, we are the number 2 player with a 15% market share. Our performance since our last Capital Markets Day and our ambition for the future is based on a core set of strengths at Aviva that are unmatched in the market, difficult to replicate, and form the basis on which we will continue to drive profitable growth. So what is the secret sauce that has allowed us to deliver consistently good results year on year and will be the platform from which we will accelerate growth going forward? Well, for a start, a key component has been a continuous focus on fundamentals. Just picking out a couple of these, in pricing, we introduced an ask it never approach to underwriting, which utilizes thousands of data points to reduce customer questions from over 100 to just 5. We have launched this simple digital online underwriting tool at Barclays this month, and this is a great blueprint for the future of integrating insurance into the banking digital ecosystems. We are continuing to expand into other markets with successful pilots in France and Canada underway. These programs, whilst in their infancy, are showing great signs of delivering on our growth, and we will accelerate this work in 2020 and 2021. Our investment in indemnity management has enabled customers to start and complete their claim online, which 44% of our customers now choose to do. More than a third of our repairs now go through Aviva-owned garages, helping over 33,000 customers annually and delivering a 15% reduction in indemnity spend. I could keep going on this and tell you about our underwriting analytics tools, machine learning pricing, and risk engineering initiatives. But suffice it to say that it is this focus on the fundamentals that will drive our growth, profit, and mix optimization strategy going forward. But these technical advantages are not the limit of Aviva's strengths. Our breadth of distribution and regional underwriting capability are clear differentiators in our core markets. Others have tried to replicate this with minimal success. Furthermore, the Aviva brand has become synonymous with relationship and service. Today, our TNPS at plus 60 for UK Holmes claims is a market leader, and Canada has the fastest growing NPS in the group. Our broker trust score stands at 89% and 92% in personal and commercial lines respectively. And for 6 years in succession, we've been voted the Insurance Company of the Year by our broker partners. That's consistency. And at Aviva, we put the customer at the very center of everything we do. At Aviva, customer-centric is not a heading, it's a culture. Our quality of service has driven our successes in winning long-term relationships with 4 of the 5 UK's largest banks to provide their insurance needs. I do want to quickly talk about P&L volatility, as Aviva operates in a very narrow range of P&L volatility compared to our peers. It is our exposure management, line size focus, reinsurance program, and disciplined underwriting that has allowed us to deliver consistent profitable growth year on year in a very narrow range of core. Our market share of losses for the last 10 weather events in the UK, including the Beast from the East, were 20% lower than our premium market share. This low volatility drives down the cost of our reinsurance. Coupled with the transactions we completed in 2000 and 2015 to remove our exposures to pre-2000 US and pre-2010 UK legacy risks of asbestos, pollution and abuse, this gives predictability to our results. This is what allows us, our reinsurers, partners and investors, to trust in our performance and in our strategy to deliver consistent profitable growth in the future. We do not have a boom-bust underwriting strategy, and we won't be implementing one. Sustainable generation of operating capital and cash flows will be the key metric by which we develop our risk and exposure strategy. Before I talk about the strategy for our key markets, I want to be clear on what our strategic priorities are. These are leading fundamentals, speed and simplicity, and focused execution. This slide actually speaks for itself. We will be the best in the market at fundamentals. We will focus on speed of execution, and we will simplify our business. Where we choose to play, we will do so in a deliberate way. Financial discipline in all decisions will be a core requirement. We will hold each other to account, and there will be no excuses. The operating model that we announced in September will drive this, with clear P&L accountabilities for all products and channels, and only underwriting where we believe we will win. Every P&L and sub-P&L will have an owner with authority to execute. Pushing accountability down will speed up decision-making and ensure those closest to the business actually make the decisions. As well as targeting growth of 20%, we are also aiming to increase our underwriting margin by moving our target core to 93 to 95% across the GI portfolio. We will drive an improvement in loss ratio through an emphasis on retention, business mix, and management of indemnity spend. We will continue to work towards a shift in business to channels where acquisition costs are lower and we can build a relationship with our customers. Let me be clear, our targets are high margin, sustainable, profitable growth, not premium. Our work on removing duplication and overlap, simplifying the business in terms of product and IT estate, and automating activities such as claim settlement and low value, high volume underwriting will help us deliver a 2% targeted reduction in operating expense. If this feels a bit like back to basics, it's because it is. I now want to give you some more detail on our strategic growth plans for the UK and Canada, and Patrick Dixneuf will go into more detail on Europe when he presents. I'm going to start with our UK personal lines business. We have made significant investments in developing the necessary tools to be the number one player in the UK market. However, we have not been delivering on our potential. But what we have shown is that when we focus, we can deliver. As you have heard from Morris, one of our big success stories has been the performance of our aggregator brand, Quote Me Happy. We launched QMH along with our general accident brand on the aggregator sites in 2011. Recognizing the need for a simple product delivered from a low-cost environment, we built this business outside of our traditional personal lines business. As a result, As you've heard, our aggregator business runs at a cost base of 5% compared to the 13% in our traditional business, has acquired in excess of 1.4 million customers and delivered a 3-year average core of 97%. With 3/4 of new business in motor and 60% in home going via aggregators, it's critical that we win in this channel. And we will be targeting this channel with new propositions in 2020. MyAviva and Aviva Plus have been rightly recognised and applauded as leading the industry for simplifying customer journeys and contributing towards a fairer market for customers. Aviva Plus has become our fastest growing product launch ever. This will continue to be a priority in 2020 and beyond as we use the Aviva service and loyalty program to drive higher retention. We have commenced a program to reduce our personal lines product set from circa 400 today to 40 by 2022. This focus on simplification is the basis on which we will drive a 20% reduction in our personal lines cost base. Our growth targets combine areas where we want to grow materially, such as direct and the aggregators, and where we will be more tempered, such as the broker channel. We will be deliberate and disciplined where we choose to participate, and just as disciplined in exiting products and markets where we cannot see a clear route to success. Turning to commercial. Our commercial UK business has been a key growth segment for us over the last 2 to 3 years, growing into high single digits every year, so that today we write 1.6 billion of net written premium. We are already number 1 player in the UK SME market and have a clear target and strategy to achieve a market share of 15% across our entire commercial portfolio. To deliver on this ambition, we have combined our commercial business under single leadership. The benefit this brings is that we can bring together the underwriting specialization, industry segment expertise, and core customer risk management together with our digitally advanced regional underwriting and distribution capabilities of our SME business. In SME, our automation of renewals up to 5K has delivered a 1% higher rate than manual renewals and improved retention by 2 to 3%. We are on target to deliver a straight-through process for 50,000 policies and remove almost 68,000 hours of non-value processes in 2020. Our corporate business has been a key engine of growth. The story here is again of where we focus, we win. In 2017, we rebranded to GCS, Global Corporate and Specialty, brought in proven senior leadership, and moved away from siloed product line underwriting to customer and sector underwriting. We have since grown this business from 2016 to 2018 by 22% and 23% in the UK and Canada respectively. Profit has increased threefold, in part driven by a clear strategy to drive retention, which has increased to 89%. Today, we are the largest underwriter of property owners in the UK, and in Canada, our surety business is the market leader. But this is just a start. We expect to continue with double-digit growth over our plan period. We also see opportunities for growth in markets such as microinsurance, a 1 billion market today, but one that's growing quickly and where our digital capability positions us well to be the dominant player. Markets that are underinsured, such as specialty risk and SME, and markets where Aviva has not previously had sufficient clarity of focus, such as the 4 billion mid-market commercial segment. Our dominant distribution position in the broker channel, service quality, and underwriting and leadership capability will deliver this growth ambition in what are high margin, high retention segments. Having spent the previous 18 months as the CEO of Canadian business, I'd like to give you an update on where we are with the turnaround program that was commenced in 2018. Well, by June of this year, we had delivered a 7% improvement year on year in core, with significantly more rate to be earned in 2020 and beyond, and the foundations in place to transform this business. We delivered this by exiting poor performing segments of our business, changing a number of our senior leaders, improving our pricing capabilities, and investing in a clear focus on customer service, whilst restructuring to ensure we had definitive end-to-end P&L accountability. In short, we got back to the discipline of underwriting. Our intent is to complete the turnaround whilst focusing on diversifying our business by product, channel, and geography. We have key initiatives underway with our partner RBC, the most recognized financial services brand in Canada, and a partnership that we extended this year by an additional 5 years so that it now runs to 2036. We also focus on continuing the growth in our GCS and SME businesses by concentrating on non-realty lines and adjacent markets such as mid-market. In personal lines, our successful growth of leisure and lifestyle with a mid-90s core will be a key initiative over the plan period, as well as developing our direct and aggregator channel distribution. So, as you've heard, our strategy for growth is simple, clear, and focused. We have defined where we want to maintain, grow, and improve in each of our major markets. We already possess strong positions in many areas, including small commercial in the UK and personal retail in Canada and Ireland. We will work hard to build on our success in those markets. To deliver on our growth aspirations, we need to ensure we have clear accountability, pace, and financial discipline. We are targeting growth areas where we already possess the tools to not only win, but to lead in these markets. Where we need to improve, we have the definitive strategies for how this will be delivered. We will be disciplined and ensure that where we cannot deliver sustainable, profitable growth, we will exit those businesses. So to conclude, I want to leave you with my 3 key priorities for Aviva's GI business. Number 1, disciplined and focused growth. An ambition to not only maintain and strengthen our positions where we already lead the market, but a clear strategy for growth in markets where we're underweight. Deliver 20% growth in GI premium and cash remittance of between 2 and 2.5 billion over the plan period. 2, low volatility, delivering higher returns. We will invest in insurance fundamentals to deliver a reduced target core of 93 to 95%, delivering a Solvency II return on capital of an excess of 14%. And 3, increased profitability by driving out cost. Through the execution of simplicity and speed, we will cut our expense ratio by 2 percentage points. We need to be lean if we're going to win. Thank you for listening. And I'm going to pass over to Patrick Dixneuf.
Good afternoon, ladies and gentlemen. It's my privilege to present our strategy for the European businesses. It's a part of Aviva that is often less discussed, less well understood. But it's worth emphasizing we deliver 1/3 of the group operating profit and are an important part of the wider Aviva story. I'm Patrick Dixneuf. I joined Aviva in 2011. I ran the Italian business for 5 years and the French business since November 2016, before Maurice asked me to take on the European role in May this year. I'm now accountable for the full portfolio, including France, Poland and Lithuania, Italy, Ireland and Turkey. For clarity, as far as GI is concerned, Colm has oversight for the GI across the Aviva group. However, as a European CEO, I will continue to be responsible for the operational delivery in the European markets with local regulatory responsibility. Today, my aim is to provide a detailed overview of our European businesses and the direction I'm taking to deliver sustainable growth. So, to my key messages. First, in Europe, we are focused where we can win and have an excellent operational track record. Second, we are actively managing through the low interest rate environment by keeping a relentless focus on insurance fundamentals, continuing to drive operating efficiency, and leveraging expertise and technology from across the group. Third, consistent with the market environment, we are changing the business mix away from guaranteed savings towards index-linked products. This strategy will deliver higher cash remittances and ensure Aviva Europe will continue to make a significant contribution to group profit, OCG, and cash. You can see our financial ambitions at the bottom of this slide. We'll deliver a return on capital of 9.5% in the life business. We will deliver around 1 billion sterling in cash and maintain a mid-90s combined ratio alongside significant GI volume growth. Over the next 20 minutes, I'll talk you through where we are today and how we will achieve our strategic ambition. I am proud to say the European business has a strong track record of delivery and growth. First, as you can see, revenues have grown. On the GI side, premiums have grown at a 6% CAGR, driven by commercial lines in France and Ireland, offset by necessary underwriting actions on motor in both Poland and Italy. On the life side, PV and BP has grown across all markets at an 18% CAGR with exceptionally strong growth in Italy due to the success of our hybrid savings product. But it's not just about a story of top-line growth. Operating profit has delivered an 11% CAGR since 2016, and we also grown OCG at 8%. Here, we benefited from both underlying growth and some good decision-making, notably in France, where we agreed to use the DVA in 2017 and the transfer of our pension business to an FRPS vehicle in 2018. I must be clear, going forward, we expect less one-offs and increased pressure on OCG due to the low interest rate environment. Our strategy will be to manage this impact so we continue to fulfill our strategic priorities. Moving to France. This is Aviva's second biggest market after the UK. We have 2.9 million customers, giving us solid positions in life and GI. We are the number 4 traditional insurer and, crucially, the leader in the distribution channels we choose to compete in. France also delivers nearly 510 million sterling in operating profit and is an important contributor to Group's OCG. Our ambition is to continue to grow the business whilst optimizing our mix towards a more capital-light portfolio. We aim to increase market share through further investment in distribution and develop market-leading propositions to serve customer needs. Aviva France has a strong position in distribution. We have an excellent, long-standing relationship with AFER, the number 1 savings association. We also own a substantial proportion of our distribution through well-known and sizable agent, broker, and IFA networks. Finally, I would just highlight the opportunities we have in France. Today, the business has a strong traditional savings base with 69 billion of reserves. But what about pensions? President Macron's government has introduced significant law changes to stimulate the pension sector, also known as the Pact Law. This will open a notable opportunity for Aviva, which I'm excited about and will address in more detail later. In Italy, we have significantly grown our life market share, supported by the success of our hybrid product, growing from number 7 3 years ago to number 5 today. On the GI side, we are focused on fixing our motor book and have a small GI market share. However, that is an opportunity for us to grow, leveraging group expertise and using our strong distribution. Aviva has strategic partnerships with 2 large banks in Italy, UniCredit and UBI Banca. Both of these arrangements come up for renewal in the next 2 years, and we are working closely with our partners on how we will take these relationships forward. That said, we have a broad customer reach with over half of our new business coming from non-captive channels, mainly IFAs and agents. We have also been investing heavily in digital to support our new GI ambition in the SME sector. A big area of focus in Italy has been our highly successful hybrid product. It provides customers with a combination of attractive yields versus the market, 3.5% in 2018, stable performance, and some protection riders. For Aviva, this means we can continue to fulfill customer demand while controlling our exposure to with-profits and Italian government bonds and providing a strong risk-adjusted return. This hybrid product is a blueprint for how I will run the life business in Europe in the coming years. In Poland, we have a very strong life business, number 2 in the market, second only to PZU, the state-owned company. In GI, we are smaller than we would like to be, but have a highly efficient business with an outstanding sub-90% core. We have already started to build out our broker distribution and develop new specialty products, putting us in a great place to grow in SME general insurance. Our main aim is to continue winning in the life market, and distribution is key to this. We have the biggest tied agent network in Poland with more than 1,800 agents. They are highly digital, with 400,000 customers actively using the MyAviva platform. Santander is also a key partner for us and a growth driver for our Polish business. We have had great success selling protection products linked to lending. This success will continue as we further penetrate Santander's growing customer base. When assessing Poland, though, it's important to understand a key market trend. The Polish life market has declined over the last few years, shrinking at a -8% CAGR since 2012. This is because insurers pulled back from single premiums investment products and moved towards protection. Although Aviva was impacted by this, our flagship unit-linked savings and protection product helped us beat the market and maintain our number 2 spot, while at the same time increasing efficiency. In Ireland, we have a strong position. We are number 2 in GI, and with a successful integration of France First, we are number 4 in life. We also have a great brand in Ireland and are the most trusted financial services company, helped by our sponsorship of the National Football and Rugby Stadium. When you get a taxi in Dublin, you can simply say, "Take me to the Aviva." That fantastic level of brand recognition supports our distribution with both intermediaries and our direct business. Of course, a key focus for us has been the integration of France First. I'm pleased to report today it is now substantially complete, and now our focus is on realizing further efficiency benefits while launching new products combining accumulation and protection features. In Turkey, our partnership with Sabancı continues to be successful, and I strongly believe that Turkey remains an attractive place to do business. It will have its ups and downs, as do all emerging markets, but we have an exceptionally strong partner and some excellent products. We are number 1 in the market for corporate pensions and number 3 private auto-enrollment provider. We have seen a significant uptick in the customer numbers, currently 2.4 million, and our focus on digital solutions will support the ongoing growth. Now, one of the questions I am most frequently asked is, how do you manage a low rate? It's a fair question, and for me, a strategic priority. Why? Because in Europe, many savings products offer guarantees. That, of course, puts pressure on our returns under current market conditions. But there are 4 factors which gives us confidence. First, all new with-profit contracts are at a 0% minimum guarantee, and we are only selling them in France and in Italy. Second, looking at our European in-force book, guarantees represent about 64% of our reserves. However, the average guarantee is less than 1% on average and is reducing fast. Third, our with-profit business has a substantial buffer between guarantees and fund yields, 200 bips in France and almost 300 bips in Italy. Finally, we have also protected our balance sheet with hedging actions, optimized asset mix, and continue to review our ALM strategy on an ongoing basis. So we are not complacent about savings, neither are we complacent about the life more generally, but we are committed to shift our business mix. This is the single best action for managing our balance sheet and is a strategic choice about how we will grow in Europe. We have been shifting our new life business mix from with profit to capital light, unit linked and protection for several years. And in 2018, over half of the Aviva Europe's life PV and BP was capital light. The current market conditions mean we needed to accelerate this, and we are. In France, we have introduced targeted marketing campaigns and scoring of clients with a Know Your Customer analysis, together with mix capping for our distributors who must deliver more than 30% unit-linked sales. I have mandated close monitoring and scoring of each network's performance and corrective actions if necessary. We will also further develop our unit-linked product offering, including structured and real asset funds at lower market volatility. In April, in cooperation with Euan asset management team, we were very proud to launch Aviva Solutions Durables, the most comprehensive ESG life insurance offering in France. In Italy, we will leverage our successful hybrid products with new business automatically switching to unit-linked over time in order to support our target mix. Coming back to France, we also have a significant opportunity to achieve our mix ambitions by leveraging the Pact Law. So I'll now address that. The so-called Pact Law will allow us to build on our savings and retirement business in France because it will ensure French consumers have much more attractive pension products to choose from. French pension system assets are projected to grow by 100 billion euro, i.e. 50%, between 2018 and 2022. Aviva has all the ingredients required for success. We have a strong distribution, a number 4 position in the individual pension market that gives us the brand recognition to leverage and also grow in the corporate field. We were the first company to set up an FRPS entity to manage pensions more efficiently and launched our first Pact product compliant product in October. Finally, we have the opportunity to leverage UK expertise to enable a more direct relationship with the customer where digital facilitates cross-selling. To give you a flavor of the opportunity, we sold more than 1,000 of our new Pact product during the first week of sale. Our ambition is to continue this promising start and outperform the market. The other half of our ambition to shift our product mix is to substantially grow our general insurance business in Europe. We have a leading position in Ireland, but although we have grown premiums and maintain a strong combined ratio, we are underweight in France, Italy, and Poland. The key growth opportunity across Europe is in the SME space, where the market is still under-penetrated. And also businesses are underserved by the big traditional GI insurers, and Aviva has a core strength, leveraging off our UK and global experience. We are ready to grow with new products to serve SMEs, including Aviva Plus in Italy, and crucially, ongoing investment in our distribution to control and own more of it. An interesting difference with the UK market is that personal lines are not as much of a commodity in Europe, so we also have ambitions to grow in that space. What really excites me is that I know we can differentiate ourselves in our European market thanks to the world-class technical skills in pricing and claims management Colm and his global GI team can give us. Another key driver of our performance in recent years has been our consistency in managing expenses. We have contained cost growth and improved unit costs while continuing to invest in the business. Our cost-income ratio has continually reduced, and I am committed it will continue to do so. We will deliver our share of Maurice's 300 million sterling commitment, with more being targeted from our less efficient markets. This applies particularly in Ireland, where we will leverage the full benefit of the France First integration. Despite a material reduction in operating expenses, we will continue to invest in the business, improving our IT estate, investing in product and distribution, and growing our brand. To recap, there are 5 things I would like you to take away today about Aviva Europe. We have an excellent track record and will continue to make a significant contribution to the group. We have taken decisive actions on both new business and the in-force book to manage through the negative interest rate environment in France, as well as interest rate volatility in Italy. We will grow our market share of investment, pension, protection, and GI to materially shift our business mix. We will continue to invest in our distribution, increasing control and ownership. And finally, we will continue to improve operating efficiency across Europe. Personally, I'm excited and inspired by the challenge and committed to deliver for our customers, our staff, and our investors. Ladies and gentlemen, many thanks, and I will hand over to Nish to present our business in Singapore.
Thanks, Patrick. Good afternoon. I'm a newcomer to this forum, so a quick introduction. I've been very fortunate to work in 5 countries, India, England, Singapore, Philippines, and Thailand. I moved to Singapore in 1995, and I worked with Watson Wyatt, Monetary Authority of Singapore, Prudential, and then I joined Aviva in 2010. I'm a qualified actuary. I hope you all don't hold that against me. My dad's an actuary too. I'm delighted to have this opportunity to present Singapore. In 2019, we won many awards. The United Nations Award for Diversity and Inclusion, the most progressive employment practices, the Workforce Transformation Champion, Distinguished Friend of the Red Cross. And 2 weeks ago, we were the only company in the financial services industry who was recognized in the top 10 great places to work. Today, I will focus on the financial performance of Singapore. At the end of 2015, we lost a major bancassurance partner, DBS, that contributed more than 60% of our individual sales. Since then, we have been the second fastest growing insurer among the top 6 insurers in terms of sales, as well as VNB, or value of new business. Whilst profit margins aren't officially published, we are fairly certain that our profit margin is the highest in the industry. Our success is underpinned by leadership in the fast-growing FA channel, leadership in the profitable group employee benefit space, and the most comprehensive product range, especially in the profitable protection sector. We will grow our business and contribute cash to the group. We have paid slightly less than £50 million as dividend this year. Over the period 2016 to 2018, our value of new business grew by 26%. And this year, Singapore will contribute about 15% of the total value of new business of the Aviva Group. In 2015, after we lost the bancassurance partner, we did an extensive study of developed markets like UK, Australia, and the US to understand as to how those markets were actually evolving. The findings were that the exclusive channels were losing steam, and independent/multi-product providers were dominating the market as that fit the needs of all the stakeholders: customers, distributors, shareholders, and regulators better. In Singapore, 80% of sales are through exclusive distribution channels. We saw a huge opportunity in adopting an FA-led strategy where our advisors offered life and general insurance products of multiple insurers. Such a strategy would put us ahead of all our competitors, as we were convinced that the top insurers in Singapore could not replicate this strategy in the short run because of the channel conflicts and their uncompetitive products. Another factor in favor of a FA-led strategy was that the FA channel had momentum and was the fastest growing channel, but was only 20% of the market. The upside was significant. We simplified our strategy into 3 bullet points. Let me explain each of these. 40 or 40. The FA share was 20% of the total market. If we could get that to 40 and get 40% of that, we would get 16% market share. Jaws is simply growing the top line twice or more than the expenses. In terms of mindset, we had to move from exclusive mindset to an excellence mindset. To win in the FA channel, nothing but the best would do. Products, service and underwriting standards to make sure that all advisors sold for us. The pursuit for growth in Singapore is fully supported by the stable political environment, world-class regulator, high per capita income, and low penetration rates compared to some other Asian markets. The huge protection gap offers us a great opportunity to continue the sales of our profitable protection products. As I said earlier, our strategy is very differentiated from the market. As a result, we have grown much faster than the industry, and our market share has more than doubled since Q1 of 2016. Our focus on the FA channel is obvious from the numbers on the slide. This puts us in a great space as the tied agency model is slowing and banks are experiencing significantly lower footfalls. In addition to adopting a differentiated strategy, one of our key priorities was to focus on profits and not on scale. 50% of our products are protection products. This is by far the highest proportion of protection products in the industry, and hence we have the highest margin in the industry. This level of profitability enables us to have short payback periods of 5 years on our investments. I would like to highlight that Singapore has generated all the growth over the last 3-4 years without any capital injection from the Aviva Group. The FA channel is the fastest growing channel in Singapore. We own 2 FA firms where advisors sell life insurance products of multiple insurers. The advisors also sell general insurance products as well as mutual funds. Our advisor numbers are growing 3 to 4 times faster than tied agency companies, and we believe this is set to continue as advisors are more productive than those in tied agencies and are able to serve customer needs better. Our success stories are spreading fast. The employee benefit segment is like most other countries. The group term is very profitable, and the group health is at best break-even. We are leaders in the profitable group term market with 30% market share. We are the trusted insurer of the government. We look after the Ministry of Defense, Ministry of Home Affairs, and all the public officers working in Singapore. Overall, so group term plus health, we are number 2 and significantly ahead of the rest. This scale is important because it enables us to price our products competitively. The affinity channel is probably our biggest success story. We have a salaried sales force that acts as a gateway to converting a massive base of MINDEF and employee benefit customers, which we believe is in excess of 1 million customers, to individual customers. They primarily sell protection products. They sell about 13 policies per month, which I believe is almost unheard of. This channel could completely disrupt the banker channel in the future, as just like banks, we are able to provide our advisors with leads, but a much superior compensation model than the banks. Our product margins in 2015 were 54%, as we relied very heavily on bank assurance. We have successfully repositioned ourselves and have an industry-leading margin of 115%. As I said earlier, protection products are very profitable. Whilst we are a top 6 player overall, we are a top 3 player in the protection space. We have the most comprehensive range of protection products in Singapore. We cover term, disability, critical illness, medical, and long-term care. We are very well positioned to meet the huge protection gap in Singapore and sustain our profitability in the future. There are a few key takeaway messages. Singapore has grown VNB at 26% in the last 3 years without any capital injection. We are very well positioned to deliver sustained growth through a differentiated strategy in FA. Huge pool of circa 1 million employee benefit customers where we have a very good record of cross-selling through the affinity channel. Our product range is profitable and comprehensive enough to create great customer outcomes. We have paid circa 50 million this year and are committed to increasing dividends over the planned period. I will end my whirlwind tour of the Singapore business here. Thank you for listening.
Thanks very much, Nish. If I could invite all of the leadership team to come up and we'll do the final session of Q&A, please.
You're bigger. You go there. Okay.
Number two.
We're all set. Johnny Vo, please.
Good afternoon. Johnny Vo from Goldman Sachs. Just 3 questions. I guess the first question for Euan. There is a bit of a war out there in terms of this space that you're putting together in terms of your business. And the war is really on the restricted advice market. What is your view with regards to that and where you're positioned with your restricted advice sales force? And is there any intention to grow that? That's the first question. Second question, just in regards to Angela. I remember you saying your MA spread, you told us what your MA spread was on your book. And I remember it's about 20 to 25% lower than the leading player in the market. So how much further can you push that MA spread without pushing up capital requirements? And the third question, just in regards to Patrick, you said the bancassurance relationship with UniCredit and UBI are up. Can you remind us of the terms of that? If it is not renewed, are they required to pay you the embedded value? I seem to remember. How much would that be? Thanks very much.
You're going to go in the order that you were.
I'll deal with the first. I think we've got a relatively small restricted, just about 100 advisors in the restricted advice, and so just to put things in context, most of the flow that we see comes through either IFAs, who are obviously unrestricted in the advice they give, or in the workplace, there's often an employee benefit consultant that's involved in the initial process. What we do expect to happen, though, is particularly at workplace, is that as maybe individuals leave an employer, but they've got used to the My Pension facility and so on that we provided them with, they have the potential to become direct customers. Many of them will have sums of money that are lower than would typically attract an IFA's attention. But they might have some critical decisions to make around consolidating their pension or planning. And so we're using our advisors to making it clear that they are tied advisors to get involved in some of those conversations. And it's proving quite fruitful. So I think we just have to see how our fairly small advisor population plays into the bigger vision. But I'd say it's very much an important part potentially of the future, but not of the here and now, where we've got a relatively small team.
I think on the MA spread, we did just talk about it half year. I think I would just say that we are very comfortable with how our portfolio plays out and the economics of our business. I think we have plenty of capital to play with in this business to write the business that we are planning to write in the market. So it doesn't act as a constraint on our plans.
Okay, Patrick, on the Italian bank insurance sales?
We don't disclose the detailed clauses of our arrangements, but I can tell you that the shareholders' interests are well protected. But maybe I can add some words about the renewals of our banking arrangements. First of all, thanks to the shift of distribution that Nacho and the team have done in Italy, none of these two bank insurance arrangements are critical to the franchise. As I was saying, more than half of the PV and BP is done through IFAs, so non-bank dependent channels. Then the choice of renewing or not renewing is not only on the bank side, it's also on our side, and that's why we are closely working with the banks today. Basically, our choice will be made on economic value and the willingness or the capability of each of the banks to be our partner in the mix journey we are on.
Ashik, please.
Hi, thank you. Ashik Musidi from JP Morgan. Just a couple of questions, one for Euan. In terms of flows, I mean, it's very clear 10 plus 10, 20 billion flows. That's around, say, 12% of opening assets if I look on the current year, external third party as well as the savings assets. So is it fair to say that 12% of opening assets will translate into 12% earnings, or there is margin pressure? Because on the cost side, you mentioned that all the headwinds that you're expecting to build the team is now more or less done. So is it fair to say that 12% flows will translate into at least 10% earnings, or do you expect some margin pressure as well? That's the first one. And second is for Angela, around the strain. I mean, I think you mentioned about 100 million long-term strain. Is that just for annuities, or is it annuities negative and offset by positive protection? Because if it's just for annuities, then say 100 million for 4 billion looks a bit low, 2%, given that these are high-yielding assets. So that's why the second one. Thank you.
Yeah, if I deal with the flow question first, I think there's two elements here. So the flows coming into Aviva Investors, I think it's important to note that over the last few years, Aviva Investors has been building capability. And so even though we've substantially grown the revenue we get from third-party business, we've been reinvesting that in building out credit teams, equity teams, distribution teams, real asset, etc. That is now finished. We've now got, so we're replete with capability. So the operational leverage on that business is quite significant. However, it does depend on the type of proposition that we're selling, how much comes through to profit. So I guess I'll probably be projecting we're going to be building the financial model over the next few months as we sort of work through. But in terms of current conditions, if we have very, very calm markets, the most immediate opportunity for us to upsell, for example, in an area like workplace into something that might be attractive to customers would be into ESG, because without market volatility, people aren't necessarily concerned about the performance of a simple passive solution that they're sitting in. If we have market volatility, that will allow us to bring out some of our more interesting, higher revenue, volatility adjusted type propositions. And I think the demand for them will come back in a more market volatile environment. So for Aviva Investors, it very much depends on what we're selling. At the minute, it's a combination of real assets and US credit. And then I think increasingly it's going to be ESG type equity strategies over the next little while, unless market conditions change materially. In terms of, so I think the answer is it depends. But you can rely on operational leverage being materially better than it has been historically in Aviva Investors. On the savings platform, we are going to have to invest a little bit further to improve customer experience. And so I think that the extent of which we're going to invest and integrate some of the propositions that Angela manufactures as we integrate, equity release elements and annuitization elements into solutions, there's going to be an investment made to make that happen. So we've got a proper solution. But we'll be working through the financial model. But I think whether it's on Aviva Investors or on the platform, as we grow assets, the margin will be improving.
And on the strain, the 100 million is for the whole portfolio, so it's everything that we're expecting to have written by the end of this year. So you're right, you've got a positive on protection and then a strain on annuities.
Dom, please.
Thanks very much. Dom Imani, Exane BNP Paribas. 3 questions if it's all right. So first on general insurance, I guess this is for both Colm and Patrick. Very clear message on back to basics and very clear on where some of the expense opportunity might be. It strikes me there must be a bit more than back to basics to get 20% top line growth. And I wonder if you might just be able to crystallize and put very simply to us, does that come from, how much of that comes from, new products or new segments? Where in terms of geography it's going to come from and where it is in terms of rate versus volume. I mean, there are clearly some potential headwinds on rate if I think about, say, whiplash reform in the UK. So just a little bit of something on that would be very helpful. And then Euan, you made a point about capturing a bigger share of the internally, to put it in my own language, internally sourced assets, so getting a share of the platform. Could you give us a sense at the moment of what percentage you're capturing and what your ambition might be? And then just a third question on financial forecast. Sorry to go back to these, but do the capital and cash numbers that we gave assume renewal of the Italian bank assurance deals, and do they or do they not assume a release of the Brexit provision? Thank you.
Okay, thank you.
Yeah, with regards to where is the growth going to come from, it's not even across geographies and products. So what I would expect is that, or our plan is that we'll see growth in personal lines in the aggregator and direct space, somewhat flat in the, slightly up in the strap partner space, and probably some shrinkage in the personal line space. In commercial lines, we're looking for growth in SME and corporate. I mean, as I've outlined, we've actually been growing in high single digits in SME in the last 2 years, and we've been growing in GCS in double digits for the last 3 years in both the UK and Canada. Canada, I would expect next year to be a continued focus on profit and return that business to its target core, but to expect to see growth in 2021 and 2022. That's going to come actually in personal lines and commercial. Some of that's going to come in RBC as RBC goes back to being a significant growth engine for our business. And that is some new launch in terms of we're launching high net worth and leisure and lifestyle products into the RBC channel. In the UK, in terms of new channels, new markets, it's more focused on mid-market, micro, and the GCS specialty risk classes into SME. Specialty risk is very much an underinsured UK market in terms of SME. So you're really going into an area that's non-competitive for where others play. Whereas mid-market, it's a market where we should be strong, but traditionally we've been strong and small and good in large, but haven't had that focus on mid-market, which we now have a very clear set of targets on, and the growth will come from that. And then geographically, in Europe, I'll let Patrick touch on the European growth areas.
Yeah, about the 4 European franchise. In Ireland, I think that the team is technically managing very well a continued soft cycle, so I don't expect lots of growth, at least in the next two years. But now, if you take both Poland and Italy, they were almost absent from the SME space. You take the digital solutions that Nacho and the team have developed in Italy to directly address the SME customers, or the broker network which Adam is building in Poland. It has started very successfully and a lot of promises there. But it's the same in France, despite the overall premium is bigger because it's more than 1 billion in France. We were almost absent from the broker network. We were doing everything either direct or through our tied agent. We've taken the decision 2 years ago to reopen the broker channel, and we are ahead of our schedule to reach a 100 million premium in SME through the brokers in 2020.
Great. You want to talk about the internally sourced?
Yeah. I think it's important to point out that we can only sell more through any platform if we offer high quality propositions, which is why the improved investment performance and the focus we're going to have on making sure that whatever we offer is advancing the cause of the end customer is important. But these channels typically have intermediaries involved, IFAs or benefit consultants. On the IFA platform, we're about 20% at the minute. Best in class, might be around 40, and that's where we'd like to be getting to, so that we need to influence IFAs to be promoting our propositions more. On workplace, it depends what way you look at it. Ostensibly, we're 70% of that platform in the minute, but really 35% of that 70 goes straight through and is outsourced because it's passive. And so really the target there, I'd be very happy to get 70% of the flow, but I really want to be advocating more ESG active type strategies into that channel.
I'll take the cash flow one.
Yeah.
On Italy, the forecasts for remittances out of Europe don't assume any cash in or out of Italy, and we could have some net neutral, but there's nothing assumed either in or out of the joint ventures. And in the UK, no, we don't assume the Brexit allowance is released.
John, and then
John Hocking, Morgan Stanley. I've got two questions, please. In P&C, I can see you've obviously got scale in the UK, Canada and Ireland. Do you have scale in some of these European markets? You sort of mentioned motor in Italy with a very small share. I can see you can bring skills and knowledge in from the UK, but do you really have a long-term viable business with those type of market shares in some of those countries? That's the first question. And then secondly, on the UK, just looking at the workplace pensions business, I'm surprised that the actual assets in that business haven't grown faster given what's happened with markets. What's happening underlying in that business in terms of member flows? Are you seeing scheme ads? Because particularly given we've seen the step up in auto-enrollment contribution rates, I would have thought the asset build would have been faster. Thanks.
Colm, you want to start with or Patrick?
Yeah, let Patrick kick off, then I'll add something.
Yeah, I would not contradict that in some cases scale matters in the GI business, but it all depends on the focus you have. Typically, just to be strong in SME, benefiting from pricing, risk appetite, accumulation tools, or claims management, you can be pretty effective in the SME business, even where you're not big. What's much more important is the way you reach the distribution. That's why it was underlined in our presentation, typically, that in France you have the fourth agent network. So we are significant where we choose to operate. Now, it's true that in personal lines, scale is maybe more important than it's me, but that's also where, even if we consider that there's still some space to gain in Europe because it's less of a commodity, but where we are more cautious.
The other thing I'd add is that over the last 5 years, we've made significant investment in our digital capability at the front end, but also in our back end systems. So right now we are actually quite a lean IT infrastructure that can be exported along with the investment in products like Aviva Plus. So whilst we have a small participation right now in countries like France, given the strength of our direct capability and the way the market is growing in that, there is a great opportunity to actually grow much faster than our current position would be across the French market, which has traditionally been agent-driven rather than a direct business. And we're seeing that as well in Canada. And again, that capability of Aviva that we're now deploying in Canada, and that's both our QMH capability and our MyAviva, Aviva Plus capability. We expect to see significant growth, albeit off a small starting point, but significant growth over the coming years in those.
Who wants to respond to the workplace pension?
Yeah, just on platform. I mean, I think we've grown from 43 billion, with numbers I disclosed, 43 billion to 64 billion at the half year. Obviously, you can do the maths, and the markets have moved in our favour since then. But that's a fair, it's 50% growth over that time frame. I don't think we're distressed about that. The advisor platform's grown from 8 to 26 billion over the same time frame. So these are good growth numbers. we've obviously been working in advice space on improving and stabilising our platform. We had some issues around that slowed things down. But as I mentioned in my presentation, not slowed us down that much because we're back to number 2 in terms of net flows. So, obviously anything that's AUM based took a knock at the end of 2018 and has bounced back. So I think it's a fast growing business, and we are projecting that it will continue to grow at a similar pace.
Barry, please, and then Blair after that.
Barry Corns, Panmure Gordon. I've got 3 questions. First of all, a couple for Colm. I've been following the company long enough to remember the dash for growth in GI. So could you just go into a bit more detail as to why you don't think it's going to lead to competition in the SME UK commercial market or other areas, please? The second question is the 95% core. Is that an underlying core? We do seem to have large losses, particularly in Canada, almost every year, it seems. And I just wondered if you'd exclude things such as that. And thirdly, one for Patrick, the relationship with AFA in France, is that an annual one, or is it going on for many years? Is it renewable, please?
Okay, I mean, the first thing I'd say, it's certainly not a rush for growth. And what we've demonstrated over the last 3 years, even with the RBC acquisition taken out, that our growth has been in the high teens, very high teens. And that's been delivered at a consistent core. We've also demonstrated that how we manage underwriting risk and exposure means that our volatility is extremely low. Even the tick up you would have seen in that graph in 18 is actually driven by Canada. So the losses in Canada. So yes, Canada was a miss in 17 and 18. We make no excuses about that. I think it's a well-trodden history in terms of PYD and the way the Canadian market works currently, which is it's heavily regulated in terms of price and product. So you will, by definition, get that kind of development. What you typically find is what we had in Canada is you'll then follow it by a very long period of a hard market, which is exactly what we're experiencing right now. And the improvement that you've seen in Canada will continue. The management team there is doing a fantastic job. With regards to the UK, the growth is not just growth across the board. So we're not looking to grow in the traditional easy growth areas of commercial auto and personal auto. So where we're looking to grow is actually in the specialty risk into SME, in our corporate space, which is all around prevention, risk management and relationship management. That's driven that 89% retention that we have, and a much heavier focus on retention, which is probably fair. I would say that we've probably lost a little bit of focus on that over the last few years. We've got to get that back into our business. So this is not by any stretch or rush to growth. This is really clearly defined where this growth is coming from. And where it's coming from is from high margin, high retention businesses, predominantly commercial. But in personal lines, we have very clear ambitions around Aviva Plus. We have ambitions around the aggregator space where with a 7% market share, we believe we can build on that. And we will be looking at new propositions. But it's not about new products. It's not about new ideas. And, Maura spoke earlier, it's not about launching new things. It's about we have the investment already made. It's about now leveraging that investment to deliver that growth. And I'm very confident in our ability to deliver that.
Talking about the core?
At the core.
95% is underlying?
Sorry, the 95 core, my apologies. Yeah, the 95 is a reported core. And what you would have seen is that we've gone with a range of 93 to 95. Now, traditionally, any general insurance business will have a level of one-offs every year, be it large loss, weather, or soft, hard markets, that will drive us down to the bottom of that 93 range or the top of that 95 range. So we price on the basis of that 93 to 95. But the target core for reporting is 95. And that's why we take a very strict view of line size underwriting in our business. So we haven't had a boom bust approach to underwriting that others have had. Aviva has been a consistent deliverer. So we're looking to deliver a 95 reported core across the business, subject to no big weather events, obviously.
Coming back to affair and trying to cut a long story short, what is affair in some words? It's an association that has underwritten a contract in our books. It's a collective scheme, and each of the affair members are part of this collective scheme. This cannot be moved, so it's with us forever. So not only the in-force, and everybody who would like to become a member will have a contract with us. At some point, what's possible is that the Affair Association decides not to promote that contract anymore, but to open another one with another company, but it would start greenfield. So it's a very low chance that they do this, especially in the current environment.
Thanks. It's Blair Stewart. We've got 3 questions, I think. Can you come back to the 9.5% return on capital for UK Life and IS&R? Is it possible to get some degree of split between the various component parts? You've some very capital light and some very more capital heavy components within there. And I think, Angela, you said mid-teens return on capital for some of the new businesses. Just trying to square that circle. If you can help me there. For Italy, would you expect any upfront cost of the bancassurance renewals? And what happens if they don't renew? Perhaps you could come back to that one as well. It's been asked already. And in Singapore, Nish, for the FAs, what proportion of what they're selling is Aviva product versus third party?
Okay, thanks. But why don't we start with Singapore, and then we'll go to Italian, and then we'll go back to you, Angela, last. Nish?
So it's a 3-pronged FA strategy in that sense. So we have 2 of our FAs, and then we also sell through FAs that we don't own. So the FAs that we don't own, we'd probably get about 30 to 40% of the sales. And there was one of the FAs was formed in 2001, PIAS, which will sell about 55% for Aviva and 45% for others. And then the Aviva FA was set up only 2.5 years ago, which will sell about 85% for Aviva and 15% for the others. Because it takes a little bit of time for the FA firm to mature before advisors can actually go out. So more than 50% of our advisors are licensed to sell general insurance. They are licensed to sell mutual funds. And this is a process which will happen. So Aviva FA will look more like PIS. So I think in the long run, we'd say probably 60% or 55% of Aviva, and the rest will be the others.
Okay, thanks. Patrick, is there anything you can
add? As I said, we will look at the renewal of the bank insurance arrangements through an economic value lens. And I'm not sure that the question is just about upfront payment or not upfront payment, because the total economy of the contract is made of possible upfront payment, the level of the commission, and this is that we have to appreciate before knowing whether if the renewal makes sense from a shareholder's point of view. And to the second part of your question, more than 50% of the PVNBP is now done through IFAs. So for sure, we really like the business we are doing both through UniCredit and through UB Banca, but none of these bank insurance arrangements are critical for the Italian franchise.
Okay. Jason?
I'll take the first.
Sure, go ahead.
No, I was thinking that you were speaking about the franchise, about the book.
If the relationships are not renewed, yeah,
about the book. In both
yeah.
cases, there are exit clauses. And as I answered to the first question, I can tell you it's protecting the shareholders' interest, but we were not going to disclose the exit clause we might have with these 2 arrangements.
Thanks.
I think, Blair, on the UK IS&R split, I mean, we didn't split it out for a reason, but we will probably do that in due course. The guidance that I've given is the 1% at a group level. It's not that dissimilar for management actions that is within that segment. And the new business, you can see within both the 18 and the first half results, the contribution to that return from new business, then the residual, of course, being the back book plus Aviva investors. So you can decompose it into those elements.
The question was just a rough idea of the return on capital from the various product segments within that 9.5, and I think Angela said that new business was being priced off a mid-teens return on capital. I'm just trying to square that circle. What's dragging that overall 9.5 down, if anything? Well, that's what I was getting at. Thanks.
So the return that Angela mentioned, I mentioned it as well, for the business is the lifetime of the product. Obviously, the 9.5% target is within the year, so that you don't get the mid-teens return every year. So the shape of the return is different, depends on the payback and the lifetime of the products. So that the ROE target just gives you the annual performance of the business and the way that the capital comes through.
And I guess, I mean, I'm managing it on a portfolio basis, so it does change a bit over time as well, as we're less reliant on new business, increasing the discipline, changing the mix of the business. So it changes a bit over time.
Andrew.
Good afternoon, it's Andrew. Could I ask 3 questions as well? On France, the pact law, to what degree do you expect that to be substitutional as opposed to additional business? And do you expect unit-linked margins to come down over time? In Italy, you've made the point that low rates have stopped out the capital returning to group from France. Is that not the case also in Italy? And could you expand a little bit about how your hybrid product works? And finally, individual personal pensions. Does that go over to Euan, or does it tip back into the legacy business?
So about France, honestly, it's difficult to guess whether if it's going to cannibalize the existing savings made through traditional assurance vie, or if it's going to be new business, because this multi-support assurance vie product in France were used both for savings, for transmission to heirs, and also to prepare retirement. So certainly a part of it is going to be cannibalized. Honestly, I think at the very beginning it might be an important part, which is going to derive funds from the traditional life insurance, which is not bad for us, neither for the customer, because we will be able to invest for a longer term with higher yield for the customer and lower capital charge for us. But going forward with the pension reform that should pass in the coming months, I think that the understanding of the French customer that they will also need to prepare in a more radical way their pension and being supported by tax advantage, you might also have new money. But honestly, giving you a share between the two now, I don't have my crystal ball with me. But the government views about this 100 billion is made of half and half. About Italy, I think that all the participating life insurance is sensitive to interest rates. Situation in Italy is not exactly the same than in France from my point of view. There are also risks that we are actively managing, that Nacho together with Group Finance is actively managing. But as you see from a real world point of view, the gap between the yield and the guarantee in Italy is more comfortable than in Italy. Why? Because the interest rates in Italy are higher. So typically, the risk of low interest rate is less important in Italy, but you got, and we saw that during the so-called political uncertainty in Italy, that you have a risk because of the spread. So not exactly the same risk, but we know that we have a traditional life business that are sensitive to interest rate. And if, depending on the situation, the measures that we are taking are not the same, but we are actively managing the book.
Margins on unit linked, are they sustainable long term?
If you take a very, very long-term view, I think that there will be a consumer pressure on margins. That's why it's also very important that we are able to manage our own efficiency to keep the margin. Now, as far as I can see in our markets for the time being, it's a movement which is relatively slow.
Yeah. And on individual personal pensions, they are part of the UK savings and retirement business that will sit under Lindsay. So it's been relatively stable in terms of AUM between 12, 15 billion. So currently the most recent number about 13 billion, but it is a slower moving part. So maybe that was the bit that was slowing down the growth rate because you've got obviously workplace and advisor growing rapidly around a business that's stable. Great.
Tom?
Tom Howth, 3 from me, please. Just on Italy, just going back, it seems like the policy had been in Europe to move towards unit-linked. Obviously, the hybrid products in Italy have been driving a lot of growth. So what should we be thinking in terms of hybrid versus unit-linked sales going forward? So are you going to replace them, or are you going to continue writing hybrid, or are you really shifting across as well? On UK motor, I wondered if you could just give us an indication of what kind of rate you're putting through the book and roughly where you're seeing claims inflation. And then also in the UK, with the FCA investigation going through on the loyalty penalty, I was just wondering if you could say if you're doing anything there to manage your back book. Thank you.
Everywhere in Europe, we've just out from, 40 years where the interest rates were above the inflation. So we were in a position to serve a yield close to the inflation, to pay for our expenses and to pay for the profit. It's no more the case. So there is a part which is, on one hand, customer education, that they have to understand that they might have safety on one end and performance on the other end, but it will not be in a single product. And on the second hand, we need a product that allows them to do that mix in a convenient, easy way, which is typically what this hybrid product is providing. Now that it's well in the market, the share between with profit, unit-linked, the importance of the protection riders, the automatic switching capability from with profit to unit-linked are things that might evolve in the future. But the idea that it's not only through with profit that you're going to do your savings and get a yield above inflation is now very well installed in Italy and by Aviva Italy thanks to this hybrid product.
Great.
On UV renewal, we welcome the work that the FCA is doing, and we think it's right to focus on fair and transparent pricing in the market. We also welcome the fact that there's recognition that the market is not a hugely profitable market. So this is a redistribution between customer segments. At Aviva, we've recognized the issue for some time, and we've been doing a number of things. The first is we had a safeguarding approach to underwriting such that new pricing could not be hugely different to that of what renewals was. And we've been moving towards that for a number of years, both with our own underwriting and with our partners. Secondly, we launched Aviva Plus earlier this year, which specifically looks at protecting against new V renewal pricing with a price guarantee and a number of other loyalty programs within that. So we are participating with the FCA. We submitted our ideas, our thoughts, our views on what they released last week. We've had discussions with them this week. So we broadly welcome this, and we want to work with the FCA to ensure that we get the right outcome for our customers, which is something that Aviva has been agitating for some time. With regards to rate and inflation, net rate on motor for us has been running around 3%. Gross inflation has been running around 7% in motor. In home, it's been running around 8% gross, around 4% net from our perspective. In terms of rate, we have been this year rating ahead of inflation because we had seen deterioration in our margin across most of our books due to the previous inflation running higher than rate. So what you've seen in the market is a general hardening in home and somewhat of a mixed bag in motor, because we're also anticipating the impact of whiplash reform coming in next year. But broadly, we're rating 1 or 2 points ahead of inflation. And we expect that to continue into 2020, where we expect inflation to come back a small amount, but still probably run ahead of where it's been traditionally over the last 5 years. And again, that's not a bodily injury inflation. That's nearly all in physical damage where we're seeing that. So bodily injury, we've actually seen somewhat of a lessening of the reserves in that particular area.
Yeah, we'll have Stephen, please.
Thank you. It's Stephen Hayward from HSBC. On your previously given targets, how are management incentivized on these, and which target is most linked to your incentivizations? And then just a point of clarification on your remittance target. Is this net of capital injections or is this gross? Thank you.
Great. Let me take the first one. Stephen. So we have obviously two components. So one is the annual bonus plan, and one is the long-term incentive plan. So we have strong alignment with the annual bonus plan, and we're just now actually working with Remco to create the same strong alignment in the LTIP. I mean, fundamentally, I have a belief that we need to get the alignment both to our targets, but also to our shareholder expectations. So that is underway. Do you want to comment on the second question?
Yeah, the remittance targets are the cash flow we expect following new business and investments and any injections within the divisions. I suppose there might be some small capital injections, that we do through the group, but it's de minimis in the context of the targets that we put out.
Any final questions? John, and then we'll finish at the back, please.
Just on the dividend, given we've now got the Solvency II own funds construction for the targets, how is the board going to think about the dividend growth? Because we've obviously moved from a payout ratio to a progressive dividend policy. Does progressive mean inflation? And if it doesn't mean inflation, what is it actually linked to with this new target suite?
You want to tackle that?
Well, sure. I mean, the board will obviously take into account a number of factors: performance, solvency, outlook. As you would expect. From a policy perspective, progressive is maintain or progress the dividend, and that's what we've said when we move to it. And in that context, the decision will be made.
Henry Heathfield, Morningstar. Just a couple of questions. So that's the first one for Colm. You mentioned hardening in the market in Canada. Just on the back of the 2017 kind of Marshall report, I was wondering if you thought that maybe there'd be potential for more hardening coming, and whether you saw any development of kind of that decisive final claims assessments and reduction of claims assessments. And then second question for Euan. I think in 2017 you introduced a smooth fund, and I wondered how that's progressing, whether you're putting any further attention on that, whether you might build out that suite, how available it is in the workforce platform, and so forth. Thank you.
You might want to hang on to that and pass it to Jason, pass it behind you to Jason, who's the CEO of the Canadian business. But let me just initially start by talking about where we are with rate in Canada, and I think it's also rate in the corporate market as well. So what we are seeing is there are tailwinds relating to weight. They're not built into our plan right now, but we've seen a hardening, a very significant hardening in commercial property, somewhat less so motor. We're also seeing some of that hardening coming into the UK, particularly in the casualty lines as well. So slightly less so in motor and property. So there is definitely tailwinds as regards rate. In personal lines, I think there's no doubt that you're seeing very significant hardening in Canada, much needed hardening. And in the UK, home is beginning to harden in the last 6 months. You've seen some hardening of it, not as much as I think is needed. And in motor, there has been a gradual hardening in motor rates. But I'm going to let Jason just introduce himself as our CEO of Canada, and also talk about, we've done a lot of work with Marshall over the last number of years and what's going on with the Marshall report and reform in Canada.
Yeah, so just on the just to build on the rate, personal auto rate, we've had 9%. We're assuming 7% next year. The market is looking at very similar rate increases. SME, we're getting 6.7%. We're assuming the same next year. And again, the market, the noise is saying the same. And in GCS, really significant double-digit rate increases. And again, the market and the lack of capacity, particularly in commercial property, is going to prop up those kind of rate increases through 2020. In terms of the Marshall report, so there was a number of recommendations. The reality is nothing has happened with the Marshall report. I would say that the Marshall report is going to be repackaged with the new regulator, FSRA. So the old rate regulator in Ontario, Fisco, has been replaced by a new regulator. They're looking at a number of reforms, starting with getting all of the companies to be rate adequate, so that there's capacity in the market. And then they're currently in a process of engaging with stakeholders, including a group from across the industry, and we're actively involved with them, around what of the reforms and the suggestions from David Marshall's report are going to be put forward, because a number of them actually weren't practical. It was a great academic read, but not all, and we priced out all of the impacts of those reforms, but not all of them were very practical. So we're working with the regulator on that.
And just very briefly on the Smooth Fund, I mean, obviously the Smooth Fund involves high quality fund management capability, but also, you know, the balance sheet cost of providing the smoothing. So it's quite an expensive fund to push through the workplace platform, which has got you know, extensive caps. So really, I think the right market for that is the IFAs, and we know that IFAs extensively promote the Proof Fund, which is a fund with those kind of characteristics. So we know there's a market for it, and I think you can expect that that will be something that we are actively promoting.
Thanks, everyone. I'd like to invite Morris to close the proceedings. Thank you.
Thanks, Chris, and thanks, everyone. I should start by saying we've had you captive for 5 hours, and I appreciate the time that you've given to be here today as we talk about really what is the new Aviva. And I know for myself and my colleagues both here on the stage with me and those in the audience, we greatly appreciate it. What we're building is a simpler, stronger company. We're refocusing on the operating model into 5 divisions to give you far greater clarity. We've shared lots of targets, which you should hold us to account, and we're going to report on those and update on those every time we connect. We've reiterated capital strength, both in our balance sheet, but also in the capital generation forecast as we look forward. We've given guidance on our cash flow, and we expect both of those to be key components in enabling a progressive dividend. We've set some pretty important priorities that are rooted in maximizing returns ultimately for our shareholders, and we're strengthening our leadership. Thank you very much. Appreciate your time today and look forward to seeing many of you in the near future.